answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth Financial's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
And if you're thinking, Allworth, isn't this Hansen McClain? Yes, it's with Scott Hansen and Pat McClain, our new name, Allworth Financial. But we are glad you are with us on this weekend. Both myself and my co-host, we've been doing this radio program for many years, and we are financial advisors for almost 3 decades. Spend our weekdays with people like yourself. Come here on the weekends to be your financial advisors on the air.
And Allworth.
Yes.
What's the genesis behind the name change there, Mr. Hansen? I was just kind of curious.
Your name's not. We wanted to get rid of McClain.
That was it.
That's the primary objective. How do we get rid of McClain?
When we started the firm years and years ago, 26, 27 years ago, the way we actually came up with the name Hansen McClain was it was either going to be McClain Hansen or Hansen McClain. We flipped the coin. Very, very a lot of thought and marketing ideas went into the flipping of the coin. Do you remember that?
Yeah.
And then as we have grown and added more services and more advisors and more people to the firm, we have decided that a better representation of what we do is Allworth.
And while there are other financial firms with founders' names on the door, I suppose Merrill Lynch, Wells Fargo,
yes, Morgan Stanley.
Yeah, there's quite a few there. Charles Schwab. That guy just had his first and last name. That's
it was just him alone.
Yeah, but anyway, there's also a lot of firms that have
what called a branded name, and that's the direction we chose. So it is no longer Hansen McClain. It's called Allworth Financial. So
yes. So anyway, glad you're with us. And if you'd like to join us, if you have a question for us, we'd love to take your call. And a new number as well for a call to join Allworth's Money Matters with Scott Hansen, Pat McClain. 1-833-99-WORTH. That's 833, toll free, 833-99-WORTH. Numerically, it's 833-999-6784. So we'd love to take your call and hear what's on your mind. And, of course, our program is really directed about helping people get to a point in their life where they have some financial independence, where maybe they're either looking at retirement or want to be at a point where at least retirement's an option, where work is an option and not an obligation. And many of our calls are kind of driven around that. But we also take calls regarding anything financial related, whether it's life insurance or estate planning.
Or should I pay off a mortgage, or how do I invest my 401k or my 529, paying for kids' education, the whole bit.
Yeah.
The gamut.
Yes.
If you will.
So let's start off. We're in Florida talking with Deborah. Deborah, you're with Scott Hansen and Pat McClain, Allworth Financial.
Hi, good morning.
Hi.
My question is regarding universal life insurance. My spouse and I, we had purchased a policy for him about 33 years ago. A very nice agent, and, explained all the benefits of it in 1986. And at that time, we actually opted to put extra money in the monthly premium that was done by an automatic allotment, which has been ongoing.
Okay.
Just to add extra cash value to it, the agent explained everything about universal life. Premiums don't increase, but, here's your option to earn additional money by putting the extra money on the monthly premium, which we did.
And interest rates were very high back then, right? Double digits probably.
Right. This was in 1986 when interest rates were about, 15%. Yeah. And the policy actually states, the guarantee 4% of what you would earn on the additional money in the cash account.
Uh-huh.
So now fast forward 32, 33 years, and we suddenly get a letter from the company stating that the premiums are now going up literally threefold of what we've been paying. And in review of the policy, the only reference in there regarding premium increase or decrease is that the company has the right to halt any additional money, the member would put in, like obviously when the interest was at 1% and 2% and you could potentially make 4%, you might want to like load it up. I understand why they would want to halt that. But the challenge now is 33 years later in the retirement phase of life, they suddenly want the premium increased 3 times what it was, even though we have cash reserves.
So let's address that. What is the face value or the amount of insurance on the particular policy?
It was $50,000.
And how much cash do you have in that policy? What's the cash value today?
The cash value is about $4,800.
Okay. So
let me step back just for a minute for kind of the rest of the listeners. So universal life insurance, I think, came out right in the early 80s, became popular in the 80s and 90s, and different than whole life. It was less expensive for the cost of insurance at the period of time. And think of these policies as a couple different things going on. One is term life insurance.
That's right.
Okay. Really, and a term life insurance is really typically for the year. So what's their chance of when you're 30 years old, what's your chance of you dying that year? And so that's your term life insurance. So the older you get, the more expensive that term life insurance is going to be. So that's one factor. The second factor is think of it just like kind of a savings pool that's alongside there. So as a $50,000 policy, for example, let's say that you had saved up $49,000 in cash value. Now there would only be $1,000 of life insurance in there, which, even though it's term insurance, would be negligible.
Correct.
And the interest that you earn on the $49,000 will be more than enough to pay for that incidental cost of insurance.
And the inverse is true right here.
Yes.
So you've got $4,800 in cash in this account and a $50,000 face.
And many of these policies, Pat, when they were first introduced, interest rates were high, like Deborah was stating, 15%. So a lot of these illustrations, people thought they were being conservative by using, say, an 8% rate of return. And, of course, interest rates have been much less, so Deborah's savings on those policies have been much less, along with the insurance companies themselves, their own portfolios aren't earning as much, meaning they got to get the money somewhere, so they increase the internal cost of insurance on those policies.
That's right, exactly. So that's what's happened is, if you read the contract itself, it will actually say, we have the ability to increase the cost of insurance to a maximum of this. And what I suspect has happened in this contract is that's what they have done. So that's all behind us now.
Furthermore, the longer people have it, it ends up having adverse selection, meaning those that are in great health think, I don't need the life insurance, or I can go buy it cheaper elsewhere. And the ones who end up keeping it are the ones like, I'm so glad I've got this life insurance policy.
Because they couldn't get coverage anywhere else. So the first question is, does your husband have any health issues that would preclude him from getting new life insurance?
Well, I mean, just that he's a bit older than he was.
No, but no cancer or heart disease.
No, I mean, there's a difference of when, you get a policy, like you said, when you're 30 and when you're 63, 64 now.
Yeah. So do you need life insurance? Are you both retired?
No, not yet.
Okay. So the first question is, do you have a need for life insurance? And if the answer is no, we don't have a need for life insurance, I would just cancel this and get the $4,800 and just chalk it up to it didn't work out the way we expected.
Right.
Yeah. I mean, it's really unfortunate, and I feel for you. And it's one of these things
because we've paid in roughly $27,500 so far.
Which is why, if you listen to our show, we are a big proponent of term life insurance.
There's just not as many moving cups. You've seen like the
moving
ball.
Moving cups?
You've seen the ball where the guy's got the cups and he's trying to find the ball or whatever it is. That's what these insurance policies are like. I mean, it's so difficult to figure out what the heck's going on
inside of them.
Yes.
And they're sold as easy, simple investments, but they're anything but, which is why term insurance. So in this particular situation, if you have a need for life insurance, what you want to do is go out and buy yourself term life insurance for 5 or 10 year level term, whatever the need is. Once you qualify for that, then you cancel this and they're going to send you a check for the cash value, $4,800, and there'll be no taxes due on that $4,800.
Okay. Well, I mean that's an option. My other frustration is with the fact that I made 3 attempts calling the company, and I talked to individuals that are probably in their early 20s, and they all they could do is just tell us, well, this is what the computer says. This is what the computer. And I said, but could you at least explain to me how we got to this point?
They don't
and
know.
then they sent us a printout saying, oh, if you pay now an additional $150 a month, you've got your coverage and everything. And I said, but you're still not explaining it. And I think that's part of the other frustration for those of us that are, in our late 50s, early 60s.
Well, what's happening? So what's happening?
It's a new generation that can't explain something that happened.
Well, at least they're all energetic, first job out of high school and all. But what's happening in the policy is as your husband is getting older,
the cost of insurance is going up.
Yeah, because you're paying the difference between $50,000 and your cash value, almost $5,000. You're buying $45,000 of term insurance.
That's what you're buying, but really expensive term insurance.
And so the insurance company's trying to think, if Mark lives to a normal life expectancy, and actuaries have us in there, like we know that the cost of this insurance cost is going to get higher and higher and higher. So we need to figure out some dollar amount that this family is going to have to throw in every month to make sure there's enough money coming in to pay the premiums, plus whatever interest they can earn on the cash. Those two things are going to
so that it doesn't collapse before the age of 100.
Right.
That's what they're doing. The reality is it wasn't a good deal for you, and continuing to chase
You're not going to be able to afford this
is not going to make
when he's
it any
74.
better. So what you want to do is buy some inexpensive.
If you need insurance.
Yeah, if you need insurance, and you may or may not. If you have enough money to retire today comfortably, then you may not need insurance at all, right? Because what you're doing when you buy life insurance is you're replacing income that the family is reliant upon with the passing of a single individual. That's the reality of it. So, unfortunately, I'm sorry this happened. It is, we see it often. And which is why we stay away from very complex
insurance products.
Yes. Not only life insurance, but index annuities with large surrender charges, all kinds of garbage out there. Same stuff. So, all right. Appreciate the.
Yeah, we wish you well. And Pat, I do think that's an excellent point that you have, is that it's the complexity of these products. And here's and these had long-term surrender charges on them.
These 15 plus years.
Yeah.
I saw one today. I saw one last week. An advisor showed me the surrender charge was 14% on an indexed annuity. 14%. What does that mean? It means you put $100,000 in there and you take that money out in the first year, you get back $86,000.
So this call, right? So equity index annuities, they were not that popular 20 years ago.
Not at all.
Really rare. They're more popular today. This call that we just heard about this universal life.
Oh, we're going to hear how many years?
It's the same thing on equity index annuities. It's coming. It's the same sort of thing. It's the same sort of complexity. There is no such thing as a free lunch.
Yes. If you don't want market risk, right, then build a portfolio that stays out of the market.
Or use some other strategy to provide some protection. There's no sense bundling those things all together.
You don't need an insurance company to do that.
Having said that, the insurance industry mispriced many variable annuities, say 15 years ago.
They don't anymore.
And at that time, we had some clients going, insurance companies have been trying to buy their way out, offering, hey, we'll give you cash if you please surrender this. We'll give you some cash.
Scott, that was an anomaly.
I know, but so there, as we state that we don't like any of these products,
there was a point in time where they were priced.
They were mispriced.
They were
insurance
mispriced.
Industry.
But yeah, we couldn't actually figure out why they were pricing them that way. But the fact of the matter is, stay away from very complex insurance products.
Yeah, and any sort of investment, you want something you can get out of.
You know what its
value is? You can hire someone to fire someone the next day.
Yes. You
can buy it today and sell it tomorrow. Isn't that what I mean? Why make life more complicated? It doesn't need to be that complicated. All right, if you want to join the program, the contact number to join Hansen and McLean's Allworth Financial's Money Matters is 1-833-99-WORTH. 1-833-99-WORTH. We're in Wisconsin with Mark. Mark, you're with Hansen. Oh, you're with Scott Hansen and Pat McLean, Allworth Financial.
Do you not know who you are?
Nah, I'm confused.
Yeah, it's all new to us. What can we do for
Well,
you?
I'm talking with the Allworth All-Stars here.
Oh, I like
wow,
that.
wow.
Keep that clip there.
By the way, I do own the copyright on that.
Okay, thank you. Now you have to
Love
enforce
the
it.
show, and it's an honor to talk to you guys.
Yeah, thanks. We're glad you joined us. How can we help?
So I'm one of the many in the sandwich generation, trying to put kids through college and help aging parents.
Boy.
I'm pretty good at the college stuff and my own stuff, but the retirement end is not my specialty. So my folks are about 80 years old. Mostly worked for charity all their life, so the income was what it was, and probably gave a little more to charity than they should have. So they're reaching this too much house, too little money stage of life.
Okay.
I'd say their income is about $25,000, which is mostly Social Security. They've gotten their expenses down to about $30,000, and they're in a house that's paid off for $230,000. Trying to figure out, they're obviously going to run out of assets before they run out of life, hopefully in the next 4 or 5 years. So we're trying to figure out how to get some of the assets out of the house, or what next steps we should be taking.
So are they downsizing the house now? You had mentioned that the houses, are they going to stay in this house, or are they going to move to a new home, smaller, something easier to take care of?
They'd be willing to downsize. They've started to look, and they're not finding much that's in that particular area, much that would save them more than maybe $40,000 or $50,000. And by the time you add in realtor fees, I just don't see it.
Yep. And actually, quite frankly, if they've lived in the house for a long period of time, as long as the upkeep is good, most seniors want to age in place, which means stay in the house that they've lived in for a long period of time.
Yeah,
so
and they would like that, but they are facing condo fees that are a little high, and because the homes are getting older, the condos tacking on maintenance fees that keep seeming to increase.
Well, that's just, but it's not like the condo association's making money, right?
They're not keeping it.
Yeah, it's all going to the repairs.
So tell us,
maintenance.
How many children are in your family? You're three. And is any of them just like hitting the ball out of the park, lots of money, that sort of thing?
Out of the park? No. Yeah. But one of us is probably able to sustain this. That was one of my thoughts. Okay. I don't know how to do a promissory note, or I don't know.
So there's two ways you could go here. One is you could just go and do a reverse mortgage on your parents.
Which would not be a bad option. They are like the ideal candidate for a reverse mortgage.
Perfect for that, which is basically they're going to spend any of the equity in their home. And when they price these reverse mortgages, they look at your age, they look at the value of the property, and they assume that they're going to live to be 95 or 100, and they will say, okay, we're going to give you $150,000, and then every year that $150,000 interest is tacked onto that.
But they don't have to. They don't have to take all the cash out right up front.
Correct.
They can get a line of credit and say, all right, we need an extra $5,000 a year. We're going to use that line of credit to pull off that $5,000 a year.
And if they don't use it, then there's that much left that goes on to the heirs. So that's one of the options.
And while it may be more expensive than a traditional mortgage, the fact is you don't have to make the payments, which is the beauty of those reverse mortgages.
The other
let's say that they passed away 10 years from now, and the home's worth, let's say it's worth $300,000 at the time, and there's a mortgage balance of, let's say, $200,000. That whatever equity is still left in the house goes to the heirs. Or if they sell it to move somewhere else, they take the equity.
So it's just like a regular mortgage, but the interest compounds. That's all it is. Yep. It's a reverse mortgage, which means, in a forward mortgage, you make that interest payment every month, and this one is exactly the opposite, so it compounds. Or another option is that you...
Can I ask you a question about that a moment?
Yep,
fire away.
I sent them to somebody that I guess HUD recommends for free reverse mortgage counseling.
Mm-hmm.
And the guy told them that it's probably not a good idea for them because if one of them dies, the other one wouldn't be able to afford it. That didn't make any sense at all to me.
They're both over the age of 62, are they not?
Yeah,
able to afford what?
80.
Yeah, that makes no sense.
Yeah, that's what I thought. It was they wouldn't be able to stay in their home if one of them passed away.
That makes
That's wrong.
That's
That's
wrong.
wrong.
That's wrong. That's absolutely.
Assuming they're both on title, correct?
Yes.
Yeah, that's wrong. That's wrong. Have them go to another counselor. So part of actually getting a reverse mortgage is HUD counseling.
It's an independent counselor.
And it's an independent counselor.
But they may not have any background in financial services.
So it sounds like they ended
No,
up
seriously.
with a bad counselor. And you're more than welcome to actually listen into that counseling session, right? You're more than welcome to do that, or at least request to. So that's one way to do it, is reverse mortgage. The other way is that you and your siblings make up the difference. Oftentimes, the children aren't all at the same level. And you might say, I'm not going to go this reverse mortgage route, but I am going to kick in $500 or $1,000 or $10,000 a year in order to help mom and dad. And you're going to use that house as collateral, and you're going to actually basically be the bank yourself. Now, this runs into a few problems. One is, it depends on your relationship with your siblings, how this actually turns out.
I wouldn't do that, personally. And I have 3 older sisters. I've got great
Why
relationships.
wouldn't you do that, Scott?
And here's why I personally wouldn't. Because let's say it's 10 years down the road.
Okay.
Parents pass.
Mm-hmm.
The lion's share of the estate goes to
You.
the youngest brother, which was me, who's fine financially. And others look at it and say, wow, doesn't Scott have a nice life? And then they say, now Scott gets all the inheritance as well. That's what would be going through their minds, which is why I would not personally.
So, Scott, I am going to agree with you, because I actually have a friend that is going through this, right? And the whole family's like, well, you've got plenty of money. Why do you need this, right? Remember, bread that is eaten is soon forgotten, right? They forget when you actually.
I don't know what that means.
It means that once you
What is that analogy?
huh? All it means is that if I give you something, you will soon forget.
That's human nature. That's human nature.
You know, when you loan people money,
Of course, it's human
it sounds
nature.
great when you're loaning it to when
They're really
when
grateful.
they're paying you back.
They're not so grateful.
They're not so grateful. It's like, especially if you have money. So I think I would go the reverse mortgage.
I would, Mark. If I were in your situation,
in a minute.
Yeah, in a heartbeat.
I would just say, Mom and Dad, you're going to get a reverse mortgage, you get a line of credit.
It would take this financial stress off them, and I
would set it up that $1,000 a month or $800 a month comes right off the credit line into their checking account every month. I think they still do it like that. Do they still?
believe they do.
I don't. But needless to say, I'd do a reverse mortgage.
There's an interesting twist to this, because they served a lot of people in charity. Apparently, one of the people they served is interested in helping them out. Is that a good idea for them to?
Sure.
Yeah.
No, there's no problem at all. In fact, you'd be doing both. The person giving will probably get as much out of it as the person receiving.
Particularly if they've been a tremendous blessing in their life at an earlier stage.
Right?
Yeah. Well, would you need to set up anything?
Nothing.
Anything legal, or is it just
No.
a personal?
Well, when
gift?
they say health, if they want to give them money, they can give them.
Much as they want.
I mean, technically, if you go over $15,000 a year, it uses up part of your
But that's-
lifetime transfer, which is $11 million. But between both of them, it's $30,000 a year. If you find someone who wants to give your parents $30,000 a year, fantastic, right? But
You know what? But come to think of it, so I've supported people at our church by giving them money directly and not even taking a.
no, you don't want a loan from somebody. That's just going to complicate things.
Correct. But you could, if someone wants to repay your parents for their life of service, your parents should graciously accept that.
Yep, I agree.
Graciously.
Okay.
And you'd be doing the person that's giving the money obviously has some emotional attachment to your parents and want to show their gratitude in some manner, which I think is great for everyone.
Yeah.
But
Great,
I'd
guys.
still
And you.
I'd still be looking at the reverse mortgage.
yeah. I do both.
Okay.
Yeah, I would too. If they were my parents, I would in a heartbeat. It would take off the financial stress.
Yeah, and I do both. When someone gives you money, offers you money, as my son says, you take it.
Yeah, I'm going to forget that bread after I eat it.
All right, well, appreciate the call.
Thanks, Mark. Yeah.
Thank you, guys. Appreciate it.
Wish you well. And Pat, it is so common, people in Mark's situation.
Oh, the sandwich generation. When my parents were alive, I was that guy. right? Both sides. 5 kids in the family dynamic. Different.
And you were the financial advisor.
Correct.
I haven't went to Patty for the.
But fortunately, we stayed together through all of it. Some of our spouses viewed it differently than we did.
There is enough there. It is not just so. Like my point is why I wouldn't want to loan those dollars. It's there's siblings and there's spouses.
And remember, your sibling spouses are not a champion of you. They're hopefully a champion of their own spouse.
Typically comes first, right?
Right. You hope.
You don't get to choose your family.
Right?
So, yeah. And
I agree with you, Scott.
Interesting how all that dynamic. I like that call because it's
it brings in the whole emotion around
really does.
finance.
Money is an interesting thing. So
money has a tendency to make people more of what they already are.
It sure can amplify. We're taking a quick break. To join us, our contact number, 1-833-99-WORTH, 1-833-99-WORTH. Stick around more for Hanson and McLean.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast. Do you have a financial question that needs answering? Call us at 833-99-WORTH. That's 833-99-WORTH.
Welcome back to Allworth's Money Matters with Scott Hanson and Pat McLean. I'm Scott.
I'm Pat. Thanks for joining us.
Yeah, glad you are here with us as we continue on with our weekly radio program, or many people listen to podcast. We actually record many of these programs during the week, but aired on the weekends.
And how do we take the calls then? We give out our number. You call in.
We schedule a time.
We don't pre-screen. I guess they do pre-screen a little.
Well, we don't know what the question is.
That's us.
And we like it that way.
We want to be surprised. We don't want to study up for the question.
No, because it
takes away.
I want it to be just like if you're sitting there talking with an advisor and you throw out your question. Not always. There are times we don't know the answer off the top of our head. It's usually something kind of esoteric. But in the financial planning issues, those are the bigger issues.
Yes.
Building a portfolio is...
Well, it's a tool.
Yeah. It's kind of secondary to the financial planning issues that are involved in it.
So what happens is you call our number, 833-99-WORTH, and they schedule a time for you to interact with us. And Jasmine, our producer, does that.
Yes.
And handles all that for us.
Yeah. And we're gonna go back to calls here in just a moment. But I want to let people know we've got some more workshops coming up. We're huge on education in our organization, which is why we do this radio and podcast and videos and blogs and all kinds of other things. In addition, we do live workshops, and we're hosting additional live workshops we call this presentation Retiree Beware.
Which is, by the way, we have 4 different workshops we do throughout the year. This is my favorite.
Oh, really?
Yeah. And the reason is...
Well, it's about the people and products that people need to stay away from.
That's exactly it.
That they don't understand.
It's to help. It's to stop you from being sold bad products. No one buys these bad products. They're sold. No one reaches out and says, I wonder if I could buy an asset that actually I'll never really know the price and I won't be able to liquidate for 10 years. No one does that.
No.
So, by the way, I just described a non-traded real estate investment trust.
These are going to be in the capital region, Sacramento capital region, week of May 13th. So the week of May 13th, and Tuesday the 14th in Elk Grove, Wednesday the 15th downtown Sacramento, Thursday the 16th in Roseville, Saturday the 18th in Rancho Cordova. So during the week it's in the evenings, and on Saturday it's midday. Go to allworthfinancial.com for all information and to make a registration. You didn't need to register. allworthfinancial.com.
And these do fill up. Not only do they fill up, the last round of Social Security, we actually had to...
you did one on Saturday, and there were, how many people were there? 390 or something
Yeah,
like that?
yeah. There was almost 400.
Unbelievable.
Yes, almost 400 people. So.
They're typically not that big, by the way. But they do fill up.
They do.
They had to get a bigger room, but it's not always possible for us. So.
That's right.
All right, let's go to the calls here with Hanson and McLean's Allworth Money Matters. I got to get used to saying.
It will take us a little while.
Sorry, it's only been almost 24 years of doing the program. That's why. So we're going to Sacramento and talking with Robert. Robert, you're with Allworth Financial. Hi, Robert.
Hi, Scott. Hi, Pat. Thanks for taking my call.
Yeah, thanks for joining us.
I got a question about a long-term health care.
Okay.
And it was a good idea at the time, I think. But the problem is I'm afraid I'm not going to be able to use it. That's a good thing or a bad thing, I don't know.
It's a good thing.
Well, my wife passed away here about 3 months ago.
Oh, I'm sorry to hear that.
And I took care of her. So there goes that long-term health care. She was sick for about a year, but not very, very much in the sense that she needed to go to a particular place. So I took care of her for about a year. And then she passed away about 3 months ago. And she was suffering, so she's kind of better off than what she was sitting there trying to get along with life. So anyway, I got a notification because originally this long-term health care was with, I believe it was GE when I initially got it, and somehow it got turned over to Genworth. Have you ever heard of Genworth Life?
They're basically it's the same company. They spun it out. They spun it out. So they spun out the financial services division out of GE.
Some of their financial.
Some of it.
Yeah. So I got a letter, and and of course the thing about they were sorry to hear about my wife's passing away, and then they sent a backup letter, and it had to do with the amount of money that was in there, and I heard you talking about buying something and not get its worth out of it. Well, this has over $43,000 in the kitty.
Got it. So this is a life insurance policy.
I'm going to be able to use it unless I have to use it. But see, I have kids, so I'm counting on my kids. So what happened was I called the Genworth Life some time back and to find out what I had to do to get part of that money for whomever, either my wife or me. And the only way they can do that is if you join an actual outfit that takes care of people in that particular thing. So I tried to get my daughter to sign up, and they wouldn't do it that way. I don't know.
So was this a policy under your wife's name?
Or your name?
Both of us.
And was it life insurance?
Well, as far as I know, this says Genworth Life Insurance Company.
Yeah, but
this was, as far as I know, it was under long-term health care.
What's confusing me is the fact that you say it has $43,000 in value in it.
That's right.
So is there anywhere that it says death benefit anywhere on your paperwork?
Not that I can see.
And does it say are you making a monthly premium payment on this?
Well, I was until what happened was some time back my brother-in-law got sick, and I didn't realize that I'm with Kaiser, and Kaiser has a real good hospice program. So he, towards the end of his life, he was into the hospice program. Well, I got the same thing for my wife towards the very end because it became a little more than I could handle. So hospice was coming in, and they were helping me out with her. They'd come in about 3 times a week and take care of anything that kind of I didn't be able to handle.
But Robert, hospice and long-term care are completely different animals whatsoever. So
we're trying to figure out what you own.
We have no.
I don't know.
We don't know either. I can't figure it out.
Yes.
So here's what we're going to do. We're going to ask you to either email us or
stick on hold.
Stay on hold, and we're going to get Jasmine to collect this information from you and just send us copies of whatever you have regarding this, and we'll help you figure it out. Because
we can figure it out if we look at it, but just going off, this is like it's a fishing expertise.
Sure, I understand.
Because I think it sounds like
my problem is that I see this $43,000 plus sitting in there, and I'm saying I'm not going to be able to use that.
Well, someone's going to use it, right? If in fact it's going to be it most likely will. My guess is this is what's called an asset-based long-term care policy, which is normally life insurance with some sort of rider on it.
Okay.
That's what my guess is.
Yeah.
But I can't say definitively until we. So you send it into us. We'll actually have an advisor look at it, give you a call, and walk you
and
through.
then figure out what your kind of long-term plans are.
And then
Not
whether
with
you should.
long-term care.
My
but just-
long-term plans is I'm not going to get sick, so yeah. Because
Yeah.
I'm 86, so I'm doing fine.
Yeah, so we'll give you direction on what to do with
Okay,
this.
fine. I appreciate it.
Yeah,
Yeah.
because I can't figure it out what it is.
Even come into the office if I have to.
Okay,
What's up
well,
to you?
Well, and when you state that you don't have any plans of you needing long-term care, I don't think that's anyone's real plan. Sometimes
Well,
things
it's not.
just
Yeah, that's
happen, right?
Well,
So-
in the sense that taking care of my wife, if it was the other way around, I think we probably had a problem because I don't think she could have handled it like I had with her. So, yeah, that's a whole other.
All right, well, we'll see what we can do to help,
Yeah,
Robert. So,
wish you well,
Jasmine
Robert,
will pick it up
and
right now.
Sorry about your wife there.
Appreciate the call.
Let's continue on. 1-833-99-WORTH is the number to join Hanson and McLean.
Scott, can I say something here for a
Yeah.
second? People listening to this show, we didn't offer to do that for Robert so that we could sell him a product or our services.
No.
So if you call the show, don't. We don't do that for everyone, but obviously, Robert, we couldn't. There's no way we could help him via this phone call without actually looking at the paperwork.
Well, given the circumstances, he's
Yeah,
recently
that's-
widowed and talks about taking care of his
kind of be
taking care of his wife for the last year. I mean,
yeah.
that-
We don't want to give financial services a bad name by being good people to other people, Scott.
we're going to change the reputation.
Financial services has got one of the worst. The
And
surveys
well-earned.
show it one of the worst
Well earned.
client surveys.
All right, let's continue. We are talking with Jay. Jay, you are with Allworth Financial with Scott Hanson and Pat McLean.
Hey, thanks for taking my call. I appreciate it.
Yeah, thanks, Jay.
So my question is, should I liquidate all or part of my brokerage account? And so I figure, how about if I give you some background so you can actually answer that question? So here's the background. I've been told there'll be some consolidation of positions where I work. My position will be one of those that gets consolidated. Now, I've been assured there's a spot for me because even as they intend to consolidate, they don't intend on eliminating positions, just shifting resources from one area of the company to another as we work to reinvent ourselves.
Okay.
But, knowing that promises are probably about how much those words weigh on a printed paper, right, it concerns me. So I don't have a timeline for when this will occur because of the "we have a spot for everyone" mantra.
That might be their hope, and if business turns and the new ideas they're talking about work out well, then there's a spot for everyone. And if things don't work out as some of the new plans are doing, then
Yeah, and they do use the word reinvent, so that tells you that there's some metamorphosis taking place in the organization.
Yeah, no doubt about it. So I've been here for 30 years. So I would hope that if I did get fired, I get a package that would encompass at least a year's salary plus benefits, which would probably gross about $200,000. But I can't be certain it's a year, right? It could be more, it could be less.
Okay.
It's not one of those things that's been discussed because of the whole we have a position for everyone. So here's mine and my spouse's financial situation. We have an outstanding mortgage of $152,000 at 3.625% with a home value of $360,000. We don't have any other debt. So we
And
have
you
a
said that was
savings-
100. I'm sorry. You said how much do you owe on it?
152.
Okay.
152.
All right.
We have a savings account that has $82,000 in it. We have a brokerage account that has $109,000 in it. 62% of that is in target date fund with Vanguard, and the rest is split between Berkshire, B shares, and Apple. There's another $17,000 in company stock that's currently vested. Now, before the slowdown in Q3, these were worth $51,000, and I didn't sell it then because I didn't need the income. So, unless I know I'm going to lose a job, I probably wouldn't exercise these right now.
Okay.
We have another $674,000 in pre-tax accounts like 401ks and traditional IRAs, and then we have $51,000 in Roth IRAs. So my income
You have
varies.
nice diversification amongst strategies for when you go to retire, I must say.
Yeah, you've done a good job.
Thank you.
How old are you?
Thank you. We're both 50.
Okay. What's your question for us?
So my question is, being somewhat conservative, knowing that this job loss what may happen, it may not. I have this $109,000 sitting in this brokerage account, and I'm wondering, should I go ahead and start liquidating this? Because what I don't want to have happen is if I lose my job and the stock market tanks, and this becomes worth 50% of what it is today, right? I'm curious as to what advice would you give a sibling as to what would you do right now in my situation?
So are you supporting children? Do you have kids in college or will be going to college soon?
We have no kids, and we're down to one dog.
All right. Well, good luck with that.
We had 3.
And all the living plants in the house need to go as well.
No living
right.
plants in the house.
So here's the reality, right? So you've been in the same employer 30 years. All your entire adult life, your career has been within one company, right? Mm-hmm. You don't know what life is like outside of that company. That's just reality.
No.
Your whole adult life's been within the company.
Do you have a college education?
I do.
Okay.
You've got, I think at this point it's almost irrelevant. It's what
a
you've
little
been doing.
little bit relevant.
Regardless, I'm highly confident, without knowing anything about you, but you kind of threw out a number of what you're paying, you would find employment elsewhere. And we've seen it enough over the years, right? So we're doing this long enough. We have people come in, they've been with the company 22 years, 28 years, whatever it is. They suddenly find themselves unemployed. They get, there's some sort of severance, or they get early retirement offer, but they're not quite ready to retire for a variety of reasons. And 9 times out of 10, they find other careers, oftentimes better than they had before. They look back, this is the best thing ever happened. So for you, it seems it's more of a perception.
And how much did you say you make a year approximately?
So the last 6 years, my W-2 has varied between 275 or AGI 275 to 305.
And does your wife work?
No, but that figure's a little misleading. I haven't really made that kind of money until the past 5 to 7 years.
Yeah.
So in the past 5 to 7 years is when we've really amassed this amount.
So let's say you went and Monday you went and sold all your holdings. You pay all the capital gain taxes. Now you no longer have those holdings working for you. They're all sitting on the sidelines ready for and let's then say it so happens that 6 months down the road you lose your job, you get some severance. You probably would be getting somewhere by a year's severance, at least 6 months, let's say. So you'd have plenty of time to find another job. In the unlikely scenario that you couldn't, that would provide some additional capital. And frankly, I think it's more to make you feel good. But let me give you another little way you can go about this. So you said if you were my brother.
I'm interested in hearing what you have to say.
If you were my brother, I'd say I wouldn't worry about it. If you're going to worry about it, why don't we buy an option, some sort of put, to protect ourselves? So if the market goes down, think of it like insurance. If the market tanks, we're going to make a bunch of money on that put.
I disagree.
So what happens? They work inverse. So if the market goes down, the value of this will spike. Yeah, and you can structure it a variety of different ways.
Correct. So you're buying a put on the marketplace that allows you to sell at a particular price.
Yeah.
But Scott, I disagree. I disagree with you. I think you're making it more complicated than it needs to be. So,
he said if he was my brother, I'm 52.
I understand.
If you were my little brother, I'd probably slap you a couple times.
But here, Scott, I'm going to guess, Jay, that you have some bonds and some cash in your company 401k.
$674,000.
Understand?
It's all in bonds?
In bonds or cash, or is it any of it in stock?
Oh no, I'm sorry. No. I have nothing in. Yeah, some of it's in bonds because it's a target date fund.
Okay.
Oh.
So here's what I would do.
You would move it out of that target inside the 401k. You'd get out of the target date.
Correct, and I would actually. So what I would do is I'm okay getting rid of the brokerage account, but not changing the positions in the brokerage account. So what that means is I would do a model in the side of the brokerage account and say, okay, let's just bring it to cash because it makes you feel good, and we're going to put it in.
But then you got the taxes deal. He's got a high income rate. I wouldn't let him pay the taxes.
Most of it's in a target date fund, and we'd actually do the analysis before we actually made the decision. So we're going to do a pro and con. You're just going to throw a put option on, and I say we're going to dig into this thing a little bit better, Scott. And I could duplicate what he has in terms of equity exposure in the brokerage account in both his Roth IRA.
Why not do that if he needs the money?
He's emotionally troubled by his holdings right now. He's worried about it.
Right. So if in your 401k you break apart the target
just do
date
it now
and build the
and
portfolio,
just wait.
So you actually have a fixed income position. Let's say it's 100 grand. Just throwing a number there. You have $100,000 in fixed income, and let's say you lose your job. You're despondent. You can't find a job anywhere. You're in the soup line, and now
the market's down.
The market's down 50%.
It doesn't matter. You're right. What? Not worry about it and just do it if we have to do it.
You can sell those positions at that time and the same day repurchase them in your IRA. So you haven't really sold. You just swapped them. Now you've eliminated the tax liability until you need it.
Correct. Okay, I'll go with Scott. So here's what we
prefer that to the
Jay.
But
so here's what we just said for the rest of the listeners. I wouldn't do a thing. I wouldn't worry about it. And if it comes to pass,
but if everything in your deferred accounts are in target date funds,
that's a mistake.
So what we'd like to do is, we're fine with the concept, but if you had separate positions so that your fixed income was a separate holding, then at sometime in the future we have the ability to swap that out for something else. If everything's in the target date fund, we can't go in there and pull out the fixed income. It's all stuck in one fund.
Yeah. And actually, it's $674,000. You should have a little bit more sophistication in your portfolio than a target date fund, even if it requires paying
I would agree. 60,000 target date's great.
Yeah, even if it means paying someone for advice in order to build or structure a portfolio.
But if you can get the concept, Jay, let's say you've got a $100,000 fixed income position in your 401k.
Which you do. It's just wrapped up in a target date fund.
So we switch it around. There's no tax consequences. We haven't sold out of any stocks. We haven't done anything. If down the road you need to access your brokerage account at $109,000,
we just duplicate that inside of your company 401k and release the cash, regardless of the value.
Yeah.
If it's $60,000 because the market's off, then it's $60,000. But you didn't sell into a falling market because you duplicated the position someplace else. So at the end of it, we suggest that you actually have someone look at your portfolio and rebalance it using individual holdings, ETFs, or mutual funds, and that you don't do anything with your brokerage account. Just leave it alone. All righty?
Okay.
So you've done a great job savings, by the way. You are a great.
Well, so far, but if your income continues between the $200,000 and $300,000 range, you're going to need to.
You need to save some. Because
unless you're saving a lot of your income now, because your lifestyle's probably increased some over the last 5 years.
It actually hasn't. We live on about $50,000 a year.
Oh, good. So the ability to replicate a new job, oftentimes is geography dependent. So
you live on $50,000 a year.
He doesn't live on $50,000 a year.
Well, let's assume you live on $75,000 a year. You're going to be fine. Even if you lost your job tomorrow, they give you some severance. You got plenty of money in the bank.
Yeah, you're fine. So appreciate the call.
Okay,
all right.
Thank you.
We wish you well. Let's continue on here in Minnesota. Nick, you're with Allworth Financial with Hanson and McLean.
Hey, thanks for taking my call.
Hi, Nick.
My wife and I started listening to your podcast about a year ago. So,
good.
Enjoyed listening to you guys.
You're cutting out on us, Nick.
Hello?
Oh, they're much better.
Yeah. Okay.
You were in the middle of complimenting us, so continue.
Just kidding. What's your issue?
Heaping compliments on you. Basically is just want to reaffirm our strategy on retiring and pulling money from our IRAs in retirement.
Okay.
I retired from full-time employment last May. I'm working now as a carpenter. I really enjoy that. And I do have a pension. Wondering when to pull Social Security.
Okay.
And Social Security at 62 for me. I'm 58 now. My wife is 55. Social Security at 62 plus my pension is slightly more than our spending plan. Our spending plan, we track it biweekly. My wife does $38.8 a year, and between pension and Social Security is about $48. So the our withdrawal plan is 4% a year out of our base. Even though, just whatever. We've been savers all our life, and if we don't take a certain amount out, we won't ever spend it.
So,
got it.
Okay, so how big is the nest egg that you're pulling the 4% off?
The total of our IRAs are $630,000.
600. Okay, so
and do you owe anything on your house?
No, we owe nothing to nobody.
So
and you need roughly $40,000 a year.
Yep.
I'm not going to give you 100% affirmation that this is the technique I would use. And the reason is, if in fact I believed I had a normal life expectancy or longer than normal life expectancy, I might take more money out of my IRA at age 62 and defer Social Security for a number of years.
Okay.
Because the guarantee.
Because of the guarantee.
Assuming
you have a normal life expectancy or they don't change. And Scott, his income overall is $48,000 a year. So the fact is, I doubt any legislative change will affect Nick. So I would bet on that. I would bet that the legislative change will not affect Nick at income of $48,000.
Matter of fact, there's a bill that was being pushed around that was going to reduce the tax burden on many retirees.
So in this particular situation, I would, and remember, you're still 4 years off, so you could stay with your spending plan now, but I wouldn't assume 100% that I would start Social Security at age 62. I would actually draw more on the IRAs and defer Social Security probably till age 67 or 70.
Okay, let me back up a second because our income would be about 48 without tapping into the IRAs.
Got it.
Oh, without the IRA. That's if you're
starting Social Security. And what I'm saying is, don't start Social Security and tap into your IRAs.
Okay.
That's what I said. Don't start Social Security and tap into the IRAs, but you're still 4 years away.
I would agree with Pat on that, too. I would agree with Pat on that.
But he's still 4 years away. So you have enough money, which is, by the way, the hard part.
Saving the money is the hard part.
Is the hard part.
The rest
is pretty easy. So you can go either direction and you'll be fine. I'm just saying that in 4 years from now, I would revisit that, and I most likely, if I was sitting at a diner and I'm your brother, I would say, let's spend some money in the IRA now and defer Social Security until 67. But I wouldn't make that decision for 4 years.
We are out of time. Join us next week for more of Allworth Financial's Money Matters with Hanson and McLean.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.